Capital structure. Welcome students. In this class we shall see what is capital structure and its factors affecting. Capital structure refers to the mix of composition or long-term sources of funds such as equity shares capital, preference share capital, debentures, long-term loans and reserves and surplus, or simply means the amount of equity and debts, or in other words owner's fund and borrowed fund. The mixture or capital contribution by these two will result in capital structure of any company. It refers to the proportion of borrowed funds to the owner's fund, or it is a mix between the equity share capitals and borrowed capital. The owner fund are called equity and the borrowed fund will result into debts. As you can see in the diagram, it is some 2/3 and 1/3 of the proportion, but an ideal equity and debt combination is said to have 50-50% shares of each other. In a capital structure, there may be combination of many things. As you can see in the diagram, there is a equity and debts combination, more than half of the equity and less than half is the debt. There can be 5 combination or any permutation or combination between equity share, preference share, debentures, loan, long-term borrowing. There can be many combination, not limited to only 5. It can be more than 5 also. Then comes financial leverage. The proportion of debts in the capital structure is called financial leverage or capital gearing or trading on equity. When the proportion of owner's fund in the capital structure is very small and it is said to be highly geared, whereas if the borrowed fund is less than the equity, then it is called low geared company. Financial leverage also means as the financial leverage increases, that is when there is highly geared, the cost of fund declined and therefore more earning per share will be there, and it will also result in the financial risk. What is financial risk? The financial risk means when there is a chance that there may be default on the payment of financial borrowings, that is interest and principal repayment, then this will result into financial risk. A simple example you can see, pause the video and you can see and observe that number of equity shares and amount of capital contribution, it will result in higher earning per share. As you can see in the last line, it is from 2 rupees per share to 2.5 rupees and also went up to 4 rupees per share when there is high amount of financial leverage. Another word is trading on equity. Trading on equity still refers to the use of fixed income securities such as debentures and loans and preference capital in the capital structure so as to increase the return on equity capital. Equity shareholders get additional profit from the help of employing other funds, and it is also known as financial leverage or capital gearing. As you can see in the example, a company raises rupees 50,000 through equity shares and earns a profit of rupees 5,000, that is 10% rate of return. And on the other hand, if the company raises 40,000 by way of 6% debentures and rupees 10,000 through equity shares, the rate of return to the equity shareholder will increase to 26%, because the difference of 10% rate of return and 6% cost of debenture, the 4% extra profit on this 40,000 means some 6% 4% for 40,000 means for just 16% will also be the benefit of equity shareholders, but it will be at the cost of financial risk. If there is a default in the payment of cash inflows from debtors and other cash inflows, then it will result in financial risk. There are some factors which will affect the choice of best capital structure. Cash flow and ability of the firm for service of the debt. Servicing debts means paying interest and principal amount of loan as and when it is due for the payment. If the debt is to be included, the capital structure of the company should estimate the future cash inflows to ensure that the amount due for payment in the form of interest, in the form of principal, is paid on time Next one, the interest coverage ratio. Interest coverage ratio refers to the number of times earning before interest and tax covers the interest obligation. In the formula given, you can see interest coverage ratio equal to EBIT, stands for earning before interest and tax, divided by fixed interest charges. Higher the ratio means the lower risk and company to pay off interest in time, and lower the ratio means the higher is risk. Both risk and the ratio are in reverse proportions. Third one is debt service coverage ratio. While paying or calculating the amount of interest along with the amount of earning, there are some factors which need to be considered, like depreciation, preference dividend, principal repayment amount, taxation obligations. All these are also part of the earning, and that too is covered in the DSCR or debt service coverage ratio. The cash profits generated from the business operation must be enough to service the debts and preferential capital and principal repayment of the debts also. Fourth factor, return on investment. ROI is higher than the rate of debts, and borrowed fund can be increased in the capital structure, otherwise increase in the equity option is good. Whenever our return on investment means earning profitability is more than the debts interest, then we will always ensure, or we will always try to go for debts instead of equity capital. Then cost of debt. If the firm is able to borrow loan and debentures at lower rate, it may prefer more debts and loan than equity in capital structure, because debts are always cheaper as compared to equity. Equity is a costly source of finance. Then comes tax rate. The income tax liability can reduced by employing borrowed fund in the capital structure, as the interest on debt is a deductible expense. While calculating the tax amount, we can calculate the tax by deducting interest charges before the payment of tax. It means more interest charges will reduce the tax liability for the business. Then comes cost of equity. When a company increases debt in their capital structure, the financial risk faced by the equity shareholders will increase. Definitely it will increase, and consequently their desire and expectation for the higher rate of return will also go up, so that the company cannot use debts beyond a given point, because increasing the debts will increase the financial risk, and increase in financial risk will always be sufficient, will not be so sufficient for equity holder to cover up. Eighth point, it is cost the incurred for floating equity shares, the shares such as brokerage, underwriting commission, etc., and it is generally less than the case of debts. So flotation cost will also be a consideration before selecting equity or debt or any combination of both the items. Next one is risk consideration. A business had two types of risk, as they are a financial risk, that is to pay interest, preference dividend, repayment of debts principal and other things, and the second one is business risk, that is the risk of profitability or operating risk. It must be considered while choosing a suitable source of capital fund, whether to debts can be employed or equity can be employed. For both risk, that is financial risk and business risk, must be taken into account. Next one is flexibility. The capital structure should be capable of being adjusted according to the need of changing condition. To maintain flexibility, the company should maintain some borrowing power to take care of unforeseen circumstances. Like, for example, if a company is in need of immediate funds, and for that immediate funds there is no scope for any issue of shares, and company cannot issue shares in a very short time. For this short time, it must have some capacity, some free assets, so that they can be placed as a mortgage to take loan on such short notice. 11th point, control. If the control of the management is to be retained, the debt financing is recommended for raising additional funds. And if the shareholders don't want to increase the financial risk, they can go for dilution of the control by equity shares and not by debts of the company. 12. Regulatory framework. Regulations and rules framed by the Security Exchange Board of India (SEBI) must be considered while choosing a capital structure, because sometimes Security Exchange Board of India gives regulation about issue of shares and debentures according to their own requirement. 13th, stock market conditions. During the depression in the stock market, investors will prefer fixed interest bearing securities for the safety and conditions. Stock market condition, if the stock market condition is very good, all shares are being sold at a very prompt time, then these will be so much beneficial to issue equity shares instead of going for borrowed funds. Then the last point says the capital structure of other companies will also be fruitful if you go for looking for them and see whether what capital structure are they following. That must also be followed in our own business. It will bring consistency and comparison for other activities. Thank you. We shall be continuing next topic in the upcoming videos. Thank you very much.